Hello everyone, welcome to my channel, and today I wanted to take a look at Keys. So as you can see, this is Keys graph right here from just yesterday. It's the 22nd of February. You can see when the market opened, it absolutely tanked from around the 180 level to even as low as low 150s. Now it is back up around that 160 mark. But yeah, this earnings report did not go down well. And I want to look at the value today. I want to see if it's an overreaction from the general investment community, if it's maybe if there's good value here now, or if actually the buy value is lower than this and we should wait for it to come down a bit more after hearing what the analysts are expecting and how the earnings report has impacted this. But first of all, let's read some headlines. Let's see why this happened. Going into the headlines, you can see. Let's have a look around one specific to Keysight Technologies. Here you go. So Keysight Technologies, worst day as shares lagged against the S&P 500. So this doesn't obviously offer much, but can tell you that they're heading for the worst day on record, as their shares dropped as much as 17%. They were as low as $151 on the day, and were down at 15% when this article came out. Additionally, it was after the company issued a fiscal revenue outlook that was a bit below what the analysts were expecting. And here you go, this one goes into a bit more detail. This is the here's why, this is the one I was looking for. So you can see it was sinking after disappointing forecasts, and they said that there was moderating demand. They didn't say that the demand was as high as people were hoping. Yeah, as you can see, it tumbled 15% on the day, and it actually reported decent earnings. It was $2 a share from 1.38 billion, and you can see they're expecting $1.85. So it was actually better than the analysts were expecting, which is quite impressive considering they managed to drop by 15%. But yes, as here it is, what hammered the stock was the word from the management that the revenue this quarter is expected to be between 1.37 and 1.39 billion, and they're expecting it around 1.4. So it's not massively below, but it is quite a bit below what the analysts were expecting, and just knowing that it's underperforming analyst expectations was enough to throw a lot of people off. And as you can see, there was a big sell yesterday. So it goes into a bit more detail there, but I want to have a look at my own buy price. Management believes problems will persist, but this analyst thinks it's a different buy price. I want to see if it was an overreaction or if it's now a great buying opportunity potentially. So let's go into the valuation of it. First, I want to start on my valuation spreadsheet. You know, the first thing I like to do is look at the risk. I want to see, first of all, the moat. I want to see what its durable competitive advantage is. So let's get rid of Google. Let's put Keys in here. And once this loads, you could see the average revenue growth across equity, the average compound annual growth rate across equity growth, earnings per share growth, operational cash flow growth, and revenue growth is sitting at 13.69%, and that's over the last sort of 7 years or so. So that to me shows a really nice stable average growth over that period. It shows to me that they can maintain their competitive advantages somewhat, and they're great at staying ahead of the competition. So that's to me manages risk a bit. I'm happy with a lower margin of safety, but there's two other things I like to check as well to go for that low margin of safety at 10% that I like. And I want to see that its return on invested capital and its free cash flow is good enough within 3 years to pay off any debt. I want to see the management's I want to see that the management is spending funds effectively, and for that I look at the return on invested capital. I want to see it consistently above that 10% mark. So let's have a look at their financials. Are the management are they investing funds efficiently, and are they keeping the return on invested capital above that 10% mark consistently over recent years? So you can see it did drop here. Return on invested capital did drop as low as 3 and 4.4 in 2017 and 2018. Other than that, the average is probably comfortably above that 10% mark. You can see it was 12.85 in before that, and since 2018, so the last 4 years here, it's been sitting at a nice level above that 10% at 14, 12, 16, 18, probably averaging out around that 12 mark because these two are so low, but that is above that 10%, especially over the recent years. So I'm happy to consider that return on invested capital above that 10% mark that I like, so I can see that they're managing their funds effectively. And on top of this, I want to see that they're not going to be in any imminent financial trouble. I want to see that they're able to pay off any long-term debt they have with their free cash flow within 3 years. So to do this, I'll just put in the long-term debt here, statements, balance, long-term debt. Let's have a look what it is. Currently it's 1.98 billion, so 1,980 million, as we'll have to deal with millions in here. And for the free cash flow, this is sitting at 1 billion at the moment, and consistently since 2018, since 2019, it's been above that 870 million mark. So that's good to see. 1,080 million for the free cash flow, and that is enough to pay off that long-term debt within 3 years. So I feel comfortable with all these metrics that there isn't any massive risk with the stock that something's gonna go horribly wrong anytime soon. So that's good to see. But now we have to go into my buy valuation of it. If you do want access to this spreadsheet or my metric meters spreadsheet, where I will update the fair value for this stock on and all my other stocks, and you can see all of my fair values, then check the link in the description. There will be one to my Patreon. But let's head into, and that's literally just, you can pay whatever you want for that above $1. It's $1 a month, but it's more just sort of like a tip if you do decide to use it. So let's put keys into the automated one and see how it comes out on the automated sheet. So in the PE for the automated one, it's coming out really nicely around that $219 mark for the fair value. But the price of the sales and price of the cash flow are coming in quite below the current market price. But we have to do a bit more than just look at the automated. This is just to give us an idea. I highly advise whenever you do use the sheet, if you do use it, go into the manual input and all these yellow fields, you update these yourself. Make sure that they are accurate and not something which was maybe happening in past years, but in terms of the current outlook, it's not looking likely. So make sure these are all set to the automated values, and yeah, they are at the moment. So now we need to go in and change these to what's actually expected. So as you can see, the analysts are expecting a 10% growth rate over 5 years. But as we know, the analysts typically are ambitious by about 100% too high. So the half analyst growth rate is sitting at 5% here. However, as the realistic growth rate we've calculated is 20%, I think we're happy enough to go not all the way down to that 5% mark, but we're still not as confident as the analysts. We'll go in around between them, 7.5. Let's see how that compares to the earnings on here. That is going from 7.97 in 2023 to 9.24 in 2025. So here, 7.97. We're currently pretty much in line with estimates here as well. So in terms of that, it does have the 20% realistic growth rate. I'm happy to leave that there for now. We'll see how that impacts the value and maybe change it later. But leave that earnings growth rate there for now, and it may potentially have to change it. But it's coming in a little bit higher than the trading view estimates here. Maybe we'll bring that down a little bit. So in terms of earnings, as we're looking at earnings right now, I think it makes sense to have a look at the PE. Currently sitting at 31.3 for this calculation, which is giving it a $218 fair valuation. I think that is slightly too high. So what I'm going to do is find out what the PE would be, what PE would be potentially more appropriate. So let's head over to Seeking Alpha. And let's have a look at the valuation on here and see if things are... I don't know why my Alexa's speaking.
Please try in a little while.
Alexa, shut up. So here we
Sorry,
go.
I can't control music.
I've unplugged it. Okay. So on keys, the median value is sitting around 18, so it's not too overvalued for the sector median for the PE. And you can see the non-gap is sitting around that 19.91 mark. And what I like to do is we look at the historic growth in terms of earnings and see how the PE was then. You can see the PE was averaging 47 over the previous 6 years. But during that time, earnings per share growth was around the 10% mark. However, that's not as representative because, as you can see, that's from 3% here, whereas it fell as low as 0.5. So since 2017, if we were to do the growth rate since then, let's change this to 6 years instead of 8 years, and instead of using D3, we'll go from this value here in F3. Then the growth rate's 49% from that year in 2017. So obviously it's very different depending on what your original starting point is. If we were to go somewhere in between, maybe around that 25% mark, that 47 maybe sitting around double. I would want to bring this 31 down. I think this 47 is not something we can expect to keep or expect to last. Let's have a look in a bit more detail at macro trends as well. Have a look at keys over a bit more time. Let's see how the key was moving over time. So you can see from this is 2020 onwards, it's been sitting pretty nicely at that 25-30 mark, never really dropping below it. However, before 2017, where it had that big boom, it was as low as 10, maybe even 15. So I think this 30 mark is just a bit too high. I want to bring it down a bit, maybe closer to the sector median. Around the 20 mark is where I would feel comfortable. I'm not saying it's not going to hit those levels at 30 again, but it's just not a prediction I'd be comfortable making with my estimation. So if I go for 20, I feel a lot more comfortable at that value, and that would bring our PE fair value around the $139 mark. If it drops to that, that's the value we'd be looking at in terms of the price over earnings, and it's a 2028 value of $244. So even if you were to have it now, it's not something I would say to sell. Even in 2024, we're expecting the value to be higher than what it is right now, up at 169, and then you'd be getting the growth that you want since then. So I don't think you desperately have to sell it, but looking at that, I think I'd want it to drop to around that 139, 140 mark before potentially looking to buy some more. But that's just the earnings. We have to look at the price over sales and the price over cash flow, see how these are impacting it as well. Price over sales isn't as important for a mature company, but it's still nice to look at. So let's check this. So the revenue currently sitting at 5,570 is the expectation for 2023. Let's put that into the revenue here. And in terms of the growth, we have 7.69 here. That's taking it to 6,400 in 2025. As you can see from the estimates here, it's only getting up to 6,150. So if we're looking to go around that mark, we have to drop this revenue growth rate. This is just based on historic revenue growth, basing it on the analyst estimates. Bring that down a little bit, maybe around the 6 mark. That's going to bring us, yeah, pretty much in line with that 6. Still a tiny bit too high. Let's bring it down a little bit more. 5, that's basically in line. But as you can see, this price over sales ratio isn't looking great. However, as I say, for mature companies, you want to focus a lot more on the price over operating cash flow and the price over earnings. Price over sales value it starts to become less relevant once a company is profitable and in that mature stage. We could potentially move this price over sales value up. As you can see, we got 2.73 in 2017. This is really dragging down the average of the lowest 4 values. It's never been below 4 other than that. I could be happy to push it probably to the 5 mark and let that sit around there, but you want to pay more attention to price over earnings and price over cash flow. So let's have a look at cash flow now. So for price over operating cash flow, currently we've got the operating cash flow at 1,144. Let's check that again. I know we looked earlier, so it's 1,290, so it's a little bit higher over the trailing 12 months than it was in 2022. So we could lift that to 1,290 for the current operating cash flow, and that's going to bring up our value a little bit. And are we comfortable with this 10% growth rate? Well, let's have a look at how it's been impacted. You can see it's going up 10% and down a bit. Instead of looking at the cash from operating activities specifically, prefer to look at the funds from operations here, because if you have a look at the funds from operations, this is really what's driving it, as the changes in working capital are much less consistent. You can see it's minus this year, then it's plus 15, plus 80, then it's minus again. Whereas the funds from operations are what's driving your cash from operating activities. You can see, based on this, for cash from operating activities, it dropped by 200 million from 2021 to 2022. Actually, they raised over 200 million more in funds from operations, just happened to have minus 400 million in change of working capital that year. So because of that, I would be willing to I would be inclined to use the funds from operations as a better indicator than the cash from operating activities. And looking at the growth here, it is pretty consistently going up quite nicely. You can see all the way from 500 million to 1.5 billion over the previous 6-7 years. It's really good to see. And what can we expect? Well, I usually like to have the cash flow growth rate sitting a little bit above that earnings growth rate. You can see the earnings growth rate at 7. I have it a little bit above. If we're treating the earnings as the net income here, the net income, you can see, always just pretty much in line with the funds from operations, just growing at that slightly slower rate, but it's basically in line. So I would happily stick it a tiny bit above that earnings growth rate, around 10%, 9%, see how that impacts the value. I'm happy to go with 10% for now, but we do need to change our price over operating cash flow multiple. Currently, the average of the lowest 4 values in the previous 6 years is 22, and you can see it averaged around 24, and now the operational cash flow growth was at 14 or 15% during that time though. So if it was at 15% during that time, we're expecting it to fall to maybe around that 10% mark. 15% brought 24, so maybe we bring it closer to the sector median again, which is at that 20 mark. I think that's where I feel more comfortable, between 18 to 20 as our price over operating cash flow value. So if I bring that down to 20, that then puts us nicely in line with our price over earnings fair value. These both come in around that 139, 140 mark, averaging right out at about that $140 fair value. And even with the price over sales being a bit more conservative, you can see that the average 2028 value being calculated here based on these estimations is sitting at $233.58. So it's very much not, I think, a desperate selling position. I think it still looks like there's nice growth to be had there. However, I would just like to see it come down a tiny bit more before I decide to buy or add to a position. So that's my personal valuation. Let's update this in the spreadsheet. So I've got keys in here already. We have to update our buy price. I did have it a bit higher before the estimations have come down from the analysts after that earnings report. We've got to change this average fair value to, yeah, I think around, as I say, price over earnings, price over cash flow is more probably relevant than the price over sales. So I'm going to go for that 140 mark rather than including the price over sales. And that's going to mean we need a 12% fall to really get to our value. And that is now with all of my other valuations, which I have a list of here, which, as I say, you can access all of these through the same Patreon that you get access to the spreadsheet here as well. If you want to see any of those, you can pay as little as $1 and see those all for yourself, and I'll keep updating fair values as I look at more. Let me know if there's anything you change here. My discount rate is sitting at 9.5% because that's what I'm looking for over the 5-year period here. And yeah, we got share dilution at minus 1.27 as they have been buying back shares. You can see quite nicely from 191 to 180 over the previous 4 years. So that's quite good to see, but I just wanted to see that fall a little bit more. Let me know if you change any of these values, if you think the earnings growth rate should be higher, if you think you can expect a higher PE multiple or maybe a higher price over operating cash flow, or if you think that it's actually worth even less than the values here and you should really sell. If there's any reasons you think that it's in big trouble, let me know and I would be really appreciative. Drop a comment and I'll speak to you in the next one. Cheers.